So if you know you're going to buy, if you know you need to buy a house, or you know you're going to refinance, you need to get your income in order. Now, let me just take a second and talk about these non-QM programs. And predominantly what I want to talk about is bank statement programs, because that's most of what gets pushed for most self-employed borrowers. And so a bank statement program is different. It's not utilizing your personal income from your tax returns, but from your bank statements. And so what happens is the lender collects your bank statements, usually for 12 or 24 months, and they calculate all of the income that comes into the account. And then they have a factor that they take out of that for expenses and everything else. And sometimes that can help you qualify for a mortgage when you otherwise would not have qualified. And it can be a great way to get you into a home, to get you into a mortgage, if you're okay with paying a higher interest rate, because the interest rate is going to be 1% to 2% higher, typically, maybe more, when you utilize one of these programs, because it is a non-qualified program, meaning it doesn't come under the restrictions of Fannie Mae and Freddie Mac, but it also means that the lender is less protected. And so they do have higher interest rates. They can be riskier loans for the lender, which is why they have higher interest rates. But sometimes it's cheaper to pay the higher rate than to, have a huge tax bill. Now, you should be filing your taxes accurately. So if it's not a real write-off, you shouldn't be doing that. But sometimes these non-QM programs work for folks who are just getting started up, and they have to write a bunch of stuff off because they just got their business started, or it's been, in the first couple of years. So bank statement loans are an option. We do offer them too, but they do come with a higher rate. They do require typically, I believe, 15, 20, 25% down, and a much stronger credit score than, say, an FHA loan. The other one would be those of you that are self-employed technically, but not really, like you're 1099 by only one company. There are programs out there that are 1099 only, where they would only look at your 1099s, and that's how they would determine if you qualify for the mortgage or not. And so those are just two examples of non-QM programs, if your tax returns aren't meeting the requirements, that you could look into. But for everyone else, you need to start showing a consistent, steady stream of income 2 years before you need to buy a house, right? And so that's the 4 tips.